Welcome to TreasuryONE's weekly market review, and it's been 2 months since the collapse of Silicon Valley Bank, and the stress remains in the US banking sector. Backstop liquidities were up last week, and it comes as more stress is expected as banks' resilience to the high interest rates continues to be tested. It also comes amid the mounting evidence of an impending recession, the latest being last week's New York Fed's Empire State Business Conditions Index. Now, April's index, which gauges manufacturing activity, plunged deep into negative territory, and it was the third weakest print relative to expectations on record. And if these signs of slowing economic activity continue, the Fed may be pushed to start cutting interest rates a lot sooner than their 2024 indication. Things also seem to be cooling over in the UK. Last week's labour market report shows a slowdown in private sector pay growth to 5.8%. And while the Bank of England will welcome the signs of a loosening labour market, it will need further evidence of disinflationary pressures before pivoting on its rate hike cycle. Now, meanwhile, over in the EU, the central bank's efforts to curb inflation seem to be taking shape. April's CPI data revealed a slowdown in core inflation to 5.6% year-on-year, with higher fuel costs really keeping that basket elevated. Then there was some good news out of Japan last week. Q1's GDP figure surprised to the upside with a 1.6% expansion. It was largely boosted by a post-COVID local demand surge. It remains to be seen, though, if the strength can be sustained. With its export-focused economy, the slump in global demand could provide some headwinds going forward. In South Africa, last week's retail figures and labour data reflect the country's economic struggles. In March, retail sales contracted for the fourth consecutive month. Ironically, though, seasonally adjusted, retail sales improved by 0.8% in Q1 compared to the end of last year, which means it will be a positive contribution to Q1's GDP figures. Last week's quarterly labour force survey shows an expansion in the country's unemployment pool in Q1. And all this then adds to the complexity in the SARB's interest rate decision this week as the economy continues to limp, inflation remains elevated, and then there's the Rand's recent blowouts on the back of continued political mishaps and a failing energy supply. The debate has been raging on whether the central bank should impose high interest rates on the market or adopt a more growth-sensitive tone. Now, we're expecting the Reserve Bank to take a bold stance in a move to protect the value of the currency by hiking the repo rate by at least 50 basis points on Thursday, with possibly more hikes to come. Before we look to the week ahead on the geopolitical front, China and the US are at it again following a G7 meeting. While the economic giants reportedly focused on de-risking their economic engagements with China, Chinese authorities did not receive this approach well, accusing the global leaders of a smear campaign against the country. And as for the Russians, they have agreed to extend the Ukraine Black Sea grain deal by a further 2 months, meaning Ukraine will be allowed to continue exporting its grain to the rest of the world. This week, the focus will remain on the discussions between Republicans and Democrats in the US to raise the country's debt ceiling, which, if not reached soon, could see America default on its $31 trillion debt, an event we think is unlikely to occur. While the SARB will remain the big focus locally, April's inflation figures also scheduled for release on Wednesday. Internationally, we'll be looking at the Federal Reserve Bank's minutes. It's out on Wednesday for some insight into the central bank's future plans. Also on Wednesday, the UK's April inflation data will be published, with a slowdown from 10.1% to 8.2% quarter-on-quarter anticipated. The Rand recorded its weakest closing levels against the US dollar on Friday as South Africa's risk profile continues to deteriorate. But the ongoing US debt ceiling discussions have put the greenback on the defensive. However, a breakthrough is expected soon, which could settle some of the market jitters and provide a boost for a broader risk appetite. Locally, the Rand is expected to take direction from Thursday's MPC announcement. Now, if the central bank's response is considered too soft, the Rand could be in for another sell-off, whereas markets may be more welcoming to a bold move from the Reserve Bank. Definitely something to watch. That then the week that was and the one to come for the markets.